As of this exact moment, NVIDIA Corporation, ticker symbol NVDA, is trading at $176.66 USD, pushing upward by a modest 0.37 points, or roughly 0.21% for the intraday session. While the broader market might glance at this fractional green movement and dismiss it as a quiet Tuesday in the semiconductor space, the reality occurring beneath the surface is far more volatile and significant than a simple percentage point suggests. Most retail investors watching their Robinhood app or checking their Fidelity mobile app see a stock that has stagnated, perhaps worrying that the momentum has stalled after the pullback from the $212 highs seen earlier this year. The expectation right now is fatigue, the belief that the artificial intelligence infrastructure boom is taking a breather and that the explosive growth is behind us. However, the reality is that we are witnessing a textbook institutional defense of the $175 level, a critical psychological and technical floor that is being reinforced by massive silent accumulation from major funds before the calendar turns to 2026. This isn't stagnation, it is a pressure cooker building steam. When you look closely at the intraday chart today, you will notice that every time the price attempts to dip below that $175 handle, it is met with immediate algorithmic buying pressure. This tells us that the smart capital is treating this level not as a point of fear, but as a point of maximum opportunity. The volume today is lighter than the average, coming in at around 62 million shares against a daily average of over 170 million, which is often interpreted as a lack of interest. In truth, declining volume during a consolidation phase is often a bullish signal because it indicates that the aggressive sellers, the ones who panicked when the stock corrected 17% from its peak, have largely exited their positions. What remains are the long-term holders and the institutions using platforms like interactive brokers to execute large block orders without disturbing the price too much. The market is currently in a wait-and-see mode, digesting the recent news regarding the White House's approval for NVIDIA to sell its H200 chips to the Chinese market, a development that completely alters the revenue modeling for the upcoming fiscal quarters. The narrative expectation has been that geopolitical tensions would severely handicap NVIDIA's ability to service the massive demand in Asia. Investors feared a complete cutoff. The reality, revealed just recently, is that the administration is taking a more pragmatic approach, allowing specific high-performance chips like the H200 to ship, provided they meet certain security thresholds. This effectively reopens a multi-billion-dollar pipeline that many analysts had written off to zero. This discrepancy between the fear of total ban and the reality of regulated sales is where the alpha lies right now. If you are managing your own self-investing strategy or using a tool like SoFi Invest to build a position, understanding this nuance is critical. You are not just buying a chip company, you are buying a company that has proven it can navigate the most complex geopolitical minefield in the technology sector and come out with its order book intact. Let's examine the price action we are seeing today in the context of the last few weeks. The stock has been trading in a tight range, bouncing between $173 and $178. This compression is classic coiling behavior. In technical analysis terms, volatility contraction leads to volatility expansion. The longer the stock stays compressed in this 175 to 178 zone, the more violent the eventual move will be. Given the macro backdrop of rate stabilization and the relentless capex spending from hyperscalers like Microsoft and Meta, the probability vector points upward. However, many retail traders, perhaps those new to online investing or using Schwab Intelligent Portfolios for the first time, might look at this sideways chop and feel frustrated. They want the instant gratification of the 5% daily candles we saw in 2024. But patience here is the differentiator. This pause is allowing the moving averages to catch up to the price, resetting the oscillators like the RSI, which had been overheated, and creating a healthy foundation for the next leg higher. Furthermore, we need to discuss the specific catalyst of the Nematron 3 open source models that NVIDIA recently released. The general market expectation is that NVIDIA is a hardware company. They sell the shovels in the gold rush. The reality is that they are rapidly becoming the dominant software platform for the entire AI industry. By releasing Nematron 3, they are not just being altruistic, they are locking developers deeper into the CUDA ecosystem. If you're a developer building an AI agent and NVIDIA gives you the best performing model for free that runs optimized on their hardware, you are never going to switch to an AMD or Intel chip. This is a strategic masterstroke that secures their moat for the next decade. While analysts at firms offering investment help or high-net-worth Fidelity Wealth Management might focus on quarterly hardware shipments, the real intrinsic value is growing in the software stickiness. This transition from pure hardware sales to a hardware plus software recurring model is what will drive the multiple expansion in the future. Speaking of competitors, it is impossible to analyze NVDA stock without looking at the relative weakness in its peers. AMD is down over 5% recently, struggling to convince the market that its MI300 series can truly take significant market share away from the H100 and Blackwell series. Intel is facing its own existential crisis. This divergence is crucial. When the sector leader holds firm at support while the competitors break down, it is a signal of immense relative strength. It suggests that capital is fleeing the second-best options and rotating back into the king of the hill. For those of you engaging in individual brokerage activities or trading via the Robinhood app, this is a signal to focus on quality. In uncertain market environments, liquidity and leadership command a premium. NVIDIA is commanding that premium right now, trading at a P/E ratio of around 43, which, believe it or not, is historically reasonable for a company growing its top line at over 60% year over year. Let's take a moment to address the elephant in the room, the upcoming 2026 fiscal year. We are just weeks away from the calendar flip, and the window dressing for year-end portfolios is underway. Fund managers who have underperformed the benchmark are desperate to show they own the winner. This leads to a phenomenon often called the chase. As we approach the final trading days of December, the buying pressure on NVDA is likely to increase simply because no fund manager wants to show a client report that doesn't list NVDA as a top holding. This structural imperative creates a natural floor under the stock price. Even if you are just doing some casual online investing or putting spare cash into Robinhood fractional shares, you are riding the wave of these massive institutional flows. The $176.66 we see right now might look expensive to someone anchoring to the prices of 2023, but if you look at the forward earnings estimates, which have been revised upward 32 times in the last month alone, the stock is arguably cheaper today than it was 6 months ago on a PEG basis. I want to pause here and ask you a question about your own positioning. Comment below how many shares of NVIDIA stock you currently hold, or if you are waiting for a dip to enter. Are you holding through this volatility, or are you taking profits? I'm genuinely curious to see how the retail sentiment stacks up against the institutional data I'm seeing. Continuing with the analysis, we have to look at the recent acquisition of ShedMD. This flew under the radar for most mainstream news outlets, but it is incredibly significant. ShedMD manages the software that optimizes workload scheduling on supercomputers. By acquiring them, NVIDIA is effectively telling its data center clients, "We won't just sell you the chips, we will ensure they run at 100% efficiency so you don't waste a single watt." In a world where power constraints are becoming the #1 bottleneck for AI data centers, this is a value add that justifies NVIDIA's high margins. They are solving the customer's biggest headache, energy efficiency, through software. This is why the gross margins are steady at 75%, a figure that is unheard of for a hardware manufacturer. Most hardware businesses are a race to the bottom on price. NVIDIA has maintained pricing power because they are selling a complete, optimized solution, not just a commodity component. We must also consider the macroeconomic environment impacting the stock today. The 10-year Treasury yield has been fluctuating, and every tick upward puts pressure on growth stocks. However, NVIDIA has decoupled from the typical high-growth, high-risk correlation. Because it generates such massive free cash flow, projected to be over $100 billion next year, it does not need to borrow capital to fund its expansion. This makes it immune to high interest rates in a way that smaller, unprofitable tech companies are not. If you are using an investing site to screen for stocks, you usually filter for low debt and high cash flow. NVIDIA passes that screen with flying colors. It is effectively a cash printing machine that happens to be at the center of the greatest technological shift since the internet. This financial fortress allows them to buy back stock, pay a small dividend, and acquire companies like ShedMD without batting an eye.